I was 27 years old before I realized that paying cash was not the best option. Stick around while we enlighten you and Anthony as to why paying cash is actually the third best option that's available for you.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. And Anthony, today we are continuing our in-depth review of Nelson Nash's book. Today we're picking it up on page 41, How to Start Building Your Banking System. And I got to say, this is probably my favorite few pages of the entire book.
Really?
Yeah.
How come?
Page 45. I've told everybody that has ever asked about this book that page 45 for me was kind of the life-changing experience. When I read that page, man, it completely changed my point of view on personal finance. And I got a little upset when I read about it. And then I got excited. So hopefully we'll take you through the anger and get you to the excitement in today's episode. Anthony, what about you? You excited about this part?
I am. And in part, before we were talking more theory, you know me, Cameron, I like to see the numbers and the data. So we start looking into that here. And I remember when I first read this book, which I think was like a couple months before you did, and reading this car example, and it is frustrating and exciting at the same time.
Yeah.
Right. Do these numbers, is this real? This is when I started. Why isn't everybody doing this? This is what really got my mind racing. And I would say, even though I've read this, I think now 10 times more than you, but I'm still picking up some nuggets.
Yeah.
And in fact, I even realized, unbeknownst to me, the part that I quote the book the most is in this section.
Mm-hmm.
I didn't even realize it till I read it for the 10th time more than you have. So I'm looking forward to being able to share that. And so we are going through back to the basics, going through becoming your own banker section by section. So today we're on page 41. If you're new to the podcast or had skipped a couple episodes, make sure you catch the other ones before to kind of learn more and make sure that you fully understand the infinite banking concept. And another thing we're doing to help you understand this is, in addition to this podcast, is we are in the process of developing our community. And so we will be rolling that out soon. We're going to be starting this out with a private Facebook group, but we're in the process of setting up the beta team. But once we do get that established, there'll be another resource that you have to be able to learn about infinite banking and also have that ability to ask questions. You can ask me questions about infinite banking, Cameron questions about hair care, and we got you covered. We got you covered.
Did you tell them that it's a Facebook group and this is really just a mask to get your Facebook profile from 5 friends up to 50? So that's what we're hoping for, guys.
Matter.
Yeah, exactly. We can break triple digits for Anthony. That'd be great. But hey, let's dive into this thing, right? Page 41, how to start building your own banking system. He's got some really good nuggets here on this first page, and he starts with the graph. Anthony, you want to give us kind of a takeaway or an overview here?
Now, what Nelson's talking about is the 5 ways to finance a car. Now, he's using a car because it's very easy to understand, for people to understand.
Yeah.
Everybody is financing a car, and it's something that you need to do over and over again. But if you're a real estate investor or any sort of investor, just think, whenever we say car, think of asset, because it's the same thing. If you're an investor, you're going to be buying assets and more assets. So just let's not focus so much on a car, because we do consider a car a liability, right? But the same thing if we use this on a down payment on a house or whatever your asset choice is. And so he goes into the 5 methods. The graph kind of lists and compares each one. The first method is leasing. And leasing is in essence just a long Toro rent, right? You're just renting the car
Mm-hmm.
for a long period of time, not building any equity, but in theory, your monthly payment is going to be less, right? But the problem is at the end of the lease, you don't have anything to show for it. Thus, 100% of your lease payments are an expense. So we're definitely not getting ahead. And then the second option is more dealer financing, meaning that you
Mm-hmm.
borrow from a bank or from a dealer. Again, this takes no capital, but in both situations, we're paying either lease payments or interest to third parties, and that money is leaving our personal economy. Then the third method he talks about, he calls it the banking method, more similar to a sinking fund method, where in this case you have to delay buying that car, right? Because if you could walk into a dealer and walk out driving a car with zero money exchanging hands, but they're able to drive that car day one. If we're going to do the sinking fund method, we need to have some discipline, and we need to wait till we build up enough money or capital to buy the car. But the key thing here is, and what is interesting, a lot of times people in this category say, hey, I don't have a car payment,
Yeah.
right? It depends how you look at it, right? You don't have an obligated car payment, but if you are going to need to buy another car. So it's somehow you do need to save up capital to buy car number two. Whether you do that systematically or sporadically, it doesn't matter. Or what you call it, as putting money in savings or a car payment, but it's the same thing. It's money that's being earmarked to go somewhere else to finance a liability, and that you will never see that money again. Now, so all three of those were not really building any equity or wealth, but the next two we are. And the next two is the using more of a CD method, and then finally the infinite banking method. So Cameron, turn it over to you as you can enlighten our audience and myself
Wow.
of ways to finance your car.
Great. Thanks, man. Page 41, the first figure that he shares is he's got the 5 ways that are listed. Anthony just went through the first three. The first three, if you look at those, they're all illustrated as negative options. You're losing money on all three of those options. And really, the opener that I shared with you was really, I was about 27 when I first read this book. And I remember reading this and I thought, dang it, why did I not know this? The best option that I thought was out there that was available to me was paying cash. And that's what I was doing. And not only did Nelson introduce me to kind of the CD method, but he also introduced us to the IBC method, which are both profitable. And so there's two options here where you can actually make money by financing your vehicles. And that's what he outlays for you. Like Anthony just mentioned, is both of these options, they do take a little bit of discipline because we've got to start saving money to begin with. And so the CD option is where you actually take deposits annually of $5,000 a year is the example that he's going to use, and you put it into a CD at the bank and you just let it sit there, and you're going to do that same process for 7 years while you build up capital. The next option is do the same thing. You're going to build up capital, but instead of putting money into a CD at a bank, is you're going to go pay a premium to a life insurance company. We're going to go through this page 45 in depth, and we're going to compare, and we're going to look at which option is better, and we're going to look at the reasons as to why they're better. One thing I'm going to add here right now, if you guys are listening to this episode, you guys have probably done some research on infinite banking. And one of the big takeaways that I had personally when I revisited this was if you look at the IBC options that is shared, he's not showing loans. He's showing withdrawals. He references it several pages in this section. On page 42, he says this process does not involve policy loans. And then again on page 47 on the addendum, right, the second item, he says 7250 is shorthand for withdrawals. So I'm going to bring this up here as I want you guys to know that there's no loans that are being shown. This is just a straight withdrawal. We're oftentimes talking about borrowing and leveraging against the policy. That's not what's happening in this comparison. So I wanted to get that out there and in front of it, make sure that everybody's on the same page there. Anthony, before we dive into kind of the page 45, did you have any other takeaways, anything you want to share here?
Well, yeah, I did, because as you know, Cameron, I've had many talks with Nelson, and we used to bring him out when he would do speaking engagements, and then the day before we would go out to dinner.
Mm-hmm.
This is not. I distinctly remember talking about this, and just, Cameron, this is not the time that we took him out to dinner, and his wife had called me dose. Right? We used to have a little thing of who knows the most about infinite banking, and I'm not going to say I'm number one. Uno, that's Nelson. I used to say that I was Dose, and then of course Cameron was Trace, but he wanted to be Dose. But I wish I had this on video. But Mary Nelson's wife, we started talking, and through the conversation, she ended up calling me Dose, which really like made my year. But Cameron, this is not the time. This was a different time.
This is not the time
This
to
is not
share
not
that
the
you
time. No.
blushed like a little
Yeah.
schoolboy when she said that either.
I know I looked straight at you with the big old smile,
Yeah.
um, but I'd asked him, Nelson, a couple things that I noticed here. We stopped making premiums or capitalizing after year 7,
Mm-hmm.
and he didn't take loans. He took withdrawals, and also he didn't finance a car till year 8 when he could have done it earlier. And what he had shared is that he was trying to make this as simple as possible and to carve out just the banking function. So he didn't want to complicate things with loans and a repayment. But he had mentioned ideally you want to take loans because you want to be able to never break that compound interest curve. And if you're doing infinite banking, you're going to need places to put capital. Whenever you take a withdrawal, not only are you breaking the compound interest curve, but that's permanent. We can never go back and put that money in. And he said the reason why he only went 7 years, again, was just to show just the capitalizing. And he said ideally you would continue to pay premiums. And also he had said, hey, if you have, he wanted to show the importance of capitalizing. That's why he didn't illustrate any activity until year 8. But again, if you had a purpose or an opportunity during that time, of course, we would want to be able to access a policy and put that to work.
Great. You have any other personal insights that you had from Nelson?
Or insults to you, they're coming.
I
Okay,
bet.
they're coming.
I bet. Awesome, man. Is as I look over this, I guess we're gonna go through page 45 in depth here, but man, you look through this and on page 43, I thought there was a really, really good quote that's in there, and it kind of made me question a few things here. But on page 43 in the top right, it says, "This is the essence of what infinite banking is all about: recovering the interest that one normally pays to some banking institution, so that the policy owner makes what a banking institution does." I thought that was key because, if I'm being honest, I think a lot of times we might put that as secondary to
Mhm.
really kind of the policy being leveraged. Uh, and so I wanted to bring that up. Anthony, kind of what are your thoughts there as far as his quote there in the book?
I, I I think, as he said earlier, he's just trying to minimize any of the noise, and just carve out specifically the banking function. But ideally you would want to continue to fund and you would want to take loans.
Yeah.
But it's what I think is interesting to know is we're breaking the compound interest curve, but this is still better than using cash,
Yeah.
or as you're going to explain, better than using a different product than whole life where he's using a CD.
Yeah, I agree with you. I appreciate that insight, and I would say that what Nelson's isolating there is really that banking function. And as we look at some of the things that we do now, as far as policy designs or what we're capable of doing now, policy designs, and then also leveraging is, man, Nelson lays a great foundation, and I think we've been able to tweak some things in here to make it even more efficient. And so, obviously, utilizing loans in this example would make everything much more efficient in the long run. But we do want to point that out. Great. Anything else?
Well, I have some comments overall about the CD method, but I thought maybe we could do that after you
Yeah.
explain it.
Yeah. Let's do it. Let's go through
Okay.
it. All right, guys. So what we're going to be doing next is we're actually going to be going through page 45, and we're going to be sharing some of the insights that we've got, or at least some of the insights that I've got on this page. For me, page 45 was critical. Anthony, if you want to start sharing. For me, page 45 was critical when I read this book. As I mentioned, this section is the one that really helped educate me on realizing that cash is not the best option and that we need to be kind of leveraging the cash and the value that we have. And so, page 45, as we go through this, again, these are the two options that Nelson lays out on page 41 as being the two best or the two profitable options. And so that's why he's going through these in depth. As we look at this on the left hand side, is we've got deposits that are outlined over here. Let me get this thing.
And so we are sharing our screen if you're watching this on the YouTube, but if you're listening to the podcast, Cameron is going to explain everything. So you don't need to be able to see the visual. However, it would help. So you could always come back and watch the video.
Perfect. Top of page 45 in the top left, really what we're looking at is the deposits. So in these two options, we've got the CD option where the individual, we used to call them sisters, CD sister, IBC sister. One sister is putting $5,000 deposit each year into a CD, and you can see that over here in this column. At the end of the year, you put in 5,000, and if it's earning 5.5% interest in a 30% tax bracket, you're going to net 4%. So you can see $5,200 there in the CD method at the end of the year. Just to the column to the right of it, what this number is, it shows $1,933. What that is actually the IBC sister, this individual putting $5,000 of premium into an insurance policy, and this is the amount of cash value that they have in the first year. Anthony, even you can figure this out. If one sister's got 5,200 and the other sister's got 1,900 of cash value available, which one's ahead at this point?
I guarantee you, the CD sisters having a fun time at Christmas dinner when they share the balances. Well, I have more than what I put in, and you have less than what you put in. What a fool!
What an idiot, right?
Yeah.
I'm going to extend this down. They look at these examples. What happens here, like Anthony mentioned, is that Nelson outlined, hey, we're going to do these deposits for the next 7 years. There's no banking, there's no borrowing, there's nothing that's going to happen. So we're going to jump down here to year 7. And again, if we look at the cash value and the CD balance, let's compare those. Anthony, what's the CD balance in year 7?
The CD balance is $41,071.
Yep, compared with how much in the IBC?
I'm going to kind of round people. So we have 41,000 to 6,000 to 36.
Awesome. So again, even at this point, the IBC method is still behind the CD method, right? For 7 years. Now we're jumped down to year number 8. And what you're going to see is that deposits have stopped. And now what you're going to see is over here in this third column is you got $10,550 that's taken out of the policy as a withdrawal, right? There's no loans in this example. And then just to the left of that, you see a loan repayment on an annual basis of $3,030. If you break that down on a monthly basis, it's $252. So you've got $10,550 that's taken out of these two respective accounts. And then you've got $252 a month that's put back into both of these accounts. And that process is replicated, duplicated 11 times over the next however many years. And so if we scroll down the screen, we're going to go all the way down to the bottom here. And we're going to go down here to year 51. This is age 71. And if we look at this, Anthony, what is the balance in the CD account?
$260,000.
And how much is in the IBC account?
Just shy of $1 million.
Just shy of $1 million, 964,000, right? Before we start to compare these two examples, I want to take a second to come back over here and add up a couple of these numbers and make sure we understand the numbers on the screen over here. On the bottom left, Nelson has 168,320,000 that's listed there. What that number is that is 133,320. That is the total amount of car payments that have been made. Additionally, that is the 35,000 of deposits that have been made that first 7 years. And so if we add those two numbers together, that's where we get the $168,320,000 number. Essentially, this number is everything that these individual would have put into this system, into this program, right? If we move to the column next to it and we look at this $116,000 number, this is going to be the 10,550, which is the purchase price of each car. And if we multiply that by 11, which means we did it 11 times, we end up with 116,050. So this is everything that was taken out of the system. So for us to find kind of the true cost of this program is we'd want to take 168 minus the 116. If we do that, Anthony, we end up with $52,270.
So what I'm hearing is they put in 52,000 more than they took out.
Correct.
Okay.
So that would be the true cost of kind of what everything put in there.
Mm-hmm.
Now this is what you want to compare the 52,270 to the 258 and the 964. So if we look at these two options, if you put in 52,000 and you end up with 258,000 at the end of the day, is that a good scenario?
Yeah.
Yeah, heck yeah, I'd take that all day long. We're positive at least 200,000 with a little bit more. Additionally, if we put in 52,000 and we end up with 964,000, is that also a good option?
Well, what do you say that's more valuable than heck yeah? I'm curious what you're going to say.
Well,
what's the next level?
I was hoping you'd do a backflip here. My point being is that there's two choices here, right? Both are good options. Which one do you want? You've got one option where you're going to end up with 258, or you've got another option of 964,000.
I'll take the 964, please.
Absolutely. So there's a difference between these two options at the end of the day of about 700,000. The actual number is 705,711. That is the difference between these two options. Anthony, what I would tell you is that $700,000 existed in the CD option. But the question I have for you is, where did it go?
It went to the bank.
And why is that?
This is the example or where of money that the bank is making off of you using them through this whole process.
Absolutely. So this number right here existed in this option over here, but again, it went to the owners of the system. And this is what Nelson is stressing in this section. He mentions it at least 3 times and just in these few pages, as far as the difference between ownership and control, right? And that's the emphasis. So he kind of gives it to us conceptually. And now what he's doing is he's laying it out kind of quantitatively and showing us that, hey, there's a mathematical difference here at the end of the day. And this is what people miss so often. And the reason that people are missing out on $700,000 in this example is because we scroll all the way back up here.
It's that Christmas dinner.
Is that Christmas dinner. Man, you got it, right? Here's an example, right, that I would have you guys do. If you guys are following along and you're reading into this book, what I want you to do is I want you to compare the CD sister versus the IBC sister. So we're just comparing these two columns here, CD versus IBC. And we're going to compare the 5200 versus the 1933 in year one. And I want you to put a plus next to whoever was ahead or whoever had more money to begin with. If you do that, we've got IBC sisters ahead in years 1, 2, 3, 4, 5, all the way down to year 15. What happens in year 14 and year 15 is year 14, the CD sister has 53,000, IBC has 52, and year 15 is the first time that the IBC sister or IBC program has actually pulled ahead of the CD method. So there's 15 years of being behind before this IBC system kind of catches up and then starts to pull away. That's the reason that people are missing out on all the benefits in the long run, is because we're short-sighted. Do you have something?
No, that's good.
I'm just scratching your face. Perfect. So we got that. So that's the reason why. What I would have you guys do is add pluses all the way down this left side, and they're going to win. The CD option is going to win for the first 15 years. But if you do the same thing on the IBC side and you write pluses, man, it's almost a 60-year difference, right? So as you go through this, again, don't be short-sighted. Don't get caught up. That's why so many people miss out on such huge windfalls over their lifetime, is because they're short-sighted. I wanted to share an example with you, kind of in regards to this. Is we had a client that called us up, and he has several policies, and he was looking for some help, for somebody to help him kind of manage these, and he didn't know what he had, to be honest. And so he's like, hey, I would love for some insight. The people that I got these policies from have not been around. They haven't answered my calls. Some of them aren't even in the business anymore. And so I started to look at the policies that he had. And I'll tell you what, man, the policies that he has are actually really, really good. The policies that he had, they're good ratios. They're with good companies. He's been funding them over the years. And what I told him was, man, I told him, congrats, that whoever did this and the way that he's been funding them really did him a favor, because very few times do you see somebody, A, that's had the right company, be the right design, but also been diligent enough to continue to fund these policies with really no one there helping him. And so that was kind of an example that I wanted to share with you guys, is that, man, if you just continue to kind of get through these first couple of years. I was looking at his policies with him, and now he's over a net $20,000 a year, kind of a positive increase on his policies. So he pays a premium, and he's got greater than $20,000 that's showing up in an annual increase, which is awesome, right? So this guy, his policies are great. They're set. So he's kind of gotten past kind of that slow start of the initial phase of funding the policies. So good takeaway.
And oftentimes we and maybe this Christmas dinner is one of the obstacles. People do get short-sighted, and they see these first couple of years, there is that slow start, and they end up giving up. And then, like, they get frustrated with the policy, and then want to cancel it. And the problem is that the first couple of years are a little difficult. We're starting a new business, but if you can get past those first couple of years, this can be a great strategy, just like you're showing here, Cameron, that the first few years we may be ahead, but if we're focused on the long term, I mean, the IBC sister she's gonna get the last laugh for many years to come.
Yeah. One of the examples that I think we shared previously is that when you're comparing this, is that you got to compare kind of these two options as if you're running a marathon, right? And so we've discussed that a marathon, rarely do you ever have somebody that is kind of a neck and neck or a photo finish. There's always a clear winner. And so if you were to train for a marathon, and I told you that I could train you, right, but you would be trailing for the first 14 miles of the race, but in mile 15 you'd pull ahead and you'd never look back, would you still let me train you?
I would tell you, me allowing you to train me, that I'd have to put my ego aside. But if I really wanted to win the race more than my ego, I would focus on, I want to cross that finish line. That is the goal. So if you could get me there faster, I would allow you to train me.
Wow. Thanks.
Dude, that even hurts to
I
say out loud.
I could hear the pain. I could hear the pain in your voice. That was difficult. So I stopped here, guys, at age 71, where we were comparing just kind of the differences at the end, and we had a $700,000 difference, but that's not even the good part, right? And this is one of the comparisons that we're going to continue to make as we move forward through the book. But man, we look at age 71 when the one sister's got 258,000, the other one's got 964. The back end of the exit strategy of this is retirement income. And what you can see here on this page is that at age 72, this sister, the CD sister, starts to take income off of the retirement of the CD account. She's able to do it for 5 years and then she runs out of money.
Well, I mean, if that's all you're doing, like that's pretty good, right? And when you're comparing it to the other three methods,
Yeah, he didn't have any money in the other.
yeah,
Yeah,
yeah.
yeah, I would agree. But if you compare it to the alternative, or
Mm.
the best, the most efficient thing that we could be doing, man, what you see here, again in the bottom right section, is you see that we end up with 964. We're able to pull off 50,000 a year for 13 years, and so this individual was able to take off $650,000 of retirement income. And in this scenario, Nelson assumes that they pass at age 85. And if that were the case, they would still pass $1.3 million to their beneficiaries.
You know, we rarely talk about the death benefit because we're so focused on the cash value. But again, this is whole life. This this is going to be there when you and your family need it most. So, well, well done, Cameron.
Yeah. If you guys want a little bit more, you guys can jump to page 47 and look at that. In this example, Nelson also highlights the fact that if somebody doesn't pass away at age 85, what happens to the retirement income and also the death benefit. And spoiler alert, it just gets better, right? So go take a look at that. Great piece to add. Anthony, any other takeaways that you've got from this section?
As a matter of fact, I do, Cameron.
Better be good.
You
Let's
know,
see.
one of the things I wanted to share when the CD method, that person has conquered Parkinson's law because they are delaying buying that car for a few years and capitalizing. They're also going to attract Willie Sutton,
Mm.
right? Because the taxes are going to be, the IRS is going to want their piece. One of the advantages of life insurance is that it grows tax free. So that CD method is great. The biggest difference is you're still using somebody else's bank. That bank went through the slow start that you would on your policy. So we're kind of coming in late in the game. That's why it looks great at the beginning, because they already went through the slow start. In this example, the IBC sister is going through her own slow start. But as you saw, she eventually was ahead of the CD sister. The problem with the CD sister is where those dividends are going, where the profits are going, um, from this banking function, and they're going to the stockholders of the bank. And as Cameron, you would point out, we had about 250 out in the CD to a million in the IBC. That's about 4 times the difference. That's what the the bank's making off of you. Because oftentimes, where's the bank storing their money or storing their cash reserves, Cam?
And life insurance.
They're getting policies on their executives, and then their executives are getting the death benefit. We're empowering people to do the same thing, but you get to put the policies on executives of the family, and then that money and that death benefit never leaves the family. Another thing I wanted to point out, what was interesting, particularly when we started doing this, man, these interest rates were high. You couldn't get 5.5 on a CD, right? And the car loan was 8.5. Do you remember trying to struggle or
Oh,
trying to explain
that
that?
was a hurdle to
Right.
overcome often.
But the dividends will, interest rates will affect the dividends of the policy, but we cannot control dividends. We can control how we use our money. And when we had recalculated the same scenario or the same premiums on a policy that we did maybe when a lower interest rate environment, the numbers were less because the interest rates were less. But you know what was interesting? At that age at 65, we still had a 4-to-1 ratio. All right. So
Mm.
we're always going to have that 4-to-1. When interest rates are higher, it's going to be a larger number. When interest rates are lower, it's going to be a smaller number, but the ratio is going to continue to be 4-to-1. And in this section, this is where one of the quotes, I didn't even realize I was I was quoting the book so much. And one thing I will use, particularly when I'm explaining, like, part of our education process is teaching people how infinite banking works, and we kind of draw it out in some. Well, you do some pretty squares. I do more. Mine really aren't squares. I don't know what you call them, but those there aren't four even sides, but close. But one thing I always say, I would always refer to the characters of the play. Right? We have the insurance company and the policy, and I just kind of did that to myself, just as a little throwback to Nelson. You
Mm,
know, every time I kind of say that, I remember Nelson kind of always talking about it, but I didn't realize it was in the book so much.
mm.
So we had talked about, I think before the last episode, the quote that you had shared the most, unbeknownst to me, this encompassed the quote that I use the most of the characters in the play.
Well said. Actually, that's one of the sections that jumped out at me as well. Was on page 43 when he says, "Let's review the characters in the play once more." Shakespeare said, "All the world's a stage, and all the people are actors thereon." He follows it up by saying, "Most folks don't understand the play." I went and I looked that up, and "All the World's a Stage" is actually a poem that Shakespeare wrote,
Mm-hmm.
and it's pretty depressing if you read
Oh,
it.
oh.
It talks about the 7 stages of life and a healthy baby being born. It talks about a man's journey through life and then how he ends up really in oblivion. He says, sans hair,
Mm.
sans teeth, sans everything. And the old guy's left with nothing. So it's pretty sad. But the other takeaway after I read that is that um, life is full of different roles, right? And so part of what I think Nelson is telling us is being able to identify which roles that you're in and which roles that you can take over. And he's talking about becoming that bank and taking over that banking function or that role. And so you got to learn the expectations and the responsibilities that come with that role. And in doing so, you'll learn to take over the financial future. So
Well said, Cam.
thanks.
And if you were looking through this, like, man, I'm not going to finance my car. I don't care too much about cars. Remember, just replace car with your asset or investment. And we actually did a similar calculation of using a bank to store the money before you buy an asset, or storing the same amount of money in a policy. So we're going to put a link to that video. I think it's going to be over here. It's but the link will be there where we did the math, kind of more showing more with the updated values. And Cameron, I will say, one of the things when you were sharing your story, well, you're gonna love this, man, because it made me feel old.
Mm.
I started thinking, how old were you when we met?
27, 28,
Dude, so
man.
you were younger than my son is now.
Oh, man.
Like that, like you being younger than Chad when we first met. I mean, I was much
You were
younger too.
probably what,
I was much
50?
younger too.
50 when we
Uh,
first
but
met? Yeah.
uh, but I think what that shows is how fast time moves, and that's what we keep reiterating. Don't focus on the short term. Time moves fast. Let's focus on the long term. And in addition, as you had mentioned, Cam, we broke the compound interest curve
Mm-hmm.
on this. We use withdrawals. We stopped paying premiums after year 7. Imagine what the numbers would be if we did not.
All right, guys. I hope you guys enjoy this episode. Remember, all the world is a stage, and you have control over what roles you play. Take back control of that financing function of your life, and you'll be better off for it.
Enjoy the episode.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.